Kenneth Andrade joins us, Chief Investment Officer with IDFC Mutual Fund. He joins us live in our Mumbai studio. Kenneth, good morning. Thank you for joining us. Kenneth, first let's try and understand where we stand in terms of market valuations versus risk-reward ratio. At the current juncture, how would you map the opportunity for us, and where is the opportunity?
Purely from a market perspective, valuations have been fair. We've seen reasonable amount of distress in the economy. This distress has given way to opportunities to actually try and pick a cyclical recovery. The only case in point out here is the latter is not happening. I don't think we're pretty far away from having a cyclical recovery in the economy, and that's going to stretch on for some periods of time. So macro events continue to be a little sticky, and it could probably keep market in this region or the entire economy or the entire corporate sector in this range for an extremely long period of time.
Kenneth, we've seen the market range bound a fair bit, while the downside has been protected at least up until now at the 5600 mark, and it struggled around the 6100 level. Do you think there is any chance that either on the upside or downside we may actually break this range? Because it seems like this is just the beginning of a downtrend that we've seen for the last couple of trading sessions.
While speaking of a broad-based index versus specific companies within that environment, I think there are a number of companies which are already at all-time lifetime highs, and there are significant amount of them at lifetime lows. So you've got polarization at both extremes of the market, and there is a certain amount of money chasing safety and capital efficiency, and that's taken valuations in that spectrum of the market to making them extremely expensive. At the other end, I'm not too sure if there's enough of appetite to buy insolvency in the business or bankruptcy in the business, and that's what's reflecting at the other extreme of the market. So indices being where they are, I think you've got two parts of the economy playing out in the market. There's been a flight to quality, and the way the environment is mobilizing, I think the flight to quality will continue to sustain itself for a period of time now.
So will this bipolar nature of the market continue, and if so, for how long? And will we stay protected at 5600, 5500 thereabouts on the downside?
It's a sticky environment, so I wouldn't want to put a number to it. But corporate profitability may be in for a slight bit of a shock going into the next year or two.
You've run a consumer-heavy portfolio for last 1 decade. That portfolio has changed. You're buying into some recovery stocks. Are you regretting that decision? Because recovery is not around the corner.
It's clearly not working. So to say that we are regretting that option that we've exercised, I may not. I'm not too sure I'll agree with it. But very simply put, that part of the environment is not working for us. On the other extreme, valuations are extremely comfortable there. But at the same time, you've got no growth. India's always been a growth market. You always wanted to chase growth, and the environment is not conducive for companies to grow into that part of the environment.
So what will be the focus for second half of this year for you? I'm asking you a very short-term dominated question, but will it be about capital preservation or about capital appreciation? Do you think it's about protecting the money which you have and forget about growth right now?
You see, even if you look at a 3 or a 5 year structure in equities, I think diversified portfolios have been able to give you a single-digit return. And that's been the focus of most managers, is trying to create an absolute return in an environment which is fairly challenging. So I guess even in the short term, while the opportunities appear to be extremely select, there will still be opportunities where you can where there are companies that are growing into this environment. So I'm not saying that there are no companies growing into this environment. It's only there are very few of them, and the nature of the job gets a little more challenging as you migrate into the next 6 months.
Kenneth, you just talked about flight to safety. Is it time then to add more to names from the IT space, select pharma, and perhaps a wee bit of FMCG?
Most managers already own a lot of these names. Okay, adding to the same, I'm not too sure if that's the way we work. And just to highlight something in the past, we tried to build a flank to the portfolio where we started buying valuations, and in the face of a cyclical recovery, that has not happened. Okay, so valuations are still fair, and it's just a matter of time wherein that entire part of the environment actually kicks back.
So you are in no mood to increase your exposure to Titan, Bata, United Spirits, Page Industries, some of your key holdings?
We haven't been doing that for the last 2 years.
So what are you buying then?
Okay, it's the same of it's the same. We're trying to pick a cyclical recovery and trying to look at companies on an individual basis rather than trying to pick a thematic and run with it.
Is that the reason why you bought banks in your portfolio? You've got PSU banks there. You've got some infra names there. Things which you've not owned in the past, are they part of your portfolio now?
That's what we've been doing for the last year, over a year now.
But Kenneth, given the earnings and given the kind of asset quality concerns that we've seen from any and every bank, does that not concern you? And most indications do seem to point to another few quarters of pain when it comes to asset quality.
Yes. I think if what's transpired over the last 6 months is probably not the best time to buy a cyclical recovery. Okay, so we'll have to wait and see how the environment maps its way through the next year or two.
Are you planning to go anywhere close to metals? Metal stocks are beaten down. A lot of these metal stocks are available not even at sub book. All of them are available even at bankruptcy levels now.